Ameriprise Financial just absolutely crushed consensus for Q2 2026, delivering a massive beat with adjusted operating earnings per share of $11.07.
Right, which is a 22% jump from last year.
Exactly, and that was followed immediately by net revenues coming in at $4.94 billion, so up 13%.
And, I mean, the stock reacted instantly, largely because they posted a staggering 55% return on equity.
Yeah, that ROE is just wild. Plus, total client assets hit a record $1.8 trillion.
Which is a massive milestone for them.
It really is. And they didn't hold back on the forward-looking guidance either. They locked in their full-year 2026 operating effective tax rate at 20 to 22%.
Right, and they projected general and administrative expenses in asset management to basically stay flat, assuming you exclude the Seligman compensation.
And maybe the biggest headline for the future, they are slating a new Huntington Bank partnership to bring $28 billion in assets right onto the platform.
So for those of you looking at the financial sector right now, that 55% ROE is your primary signal.
Right, because that's not normal for a traditional bank.
Exactly. And ROE, that high, means Ameriprise is not operating like a traditional capital-heavy banking institution. You know, they don't have to hold massive reserves against some sprawling loan book.
They're essentially running this incredibly efficient fee-based machine.
Yeah, and the mission of this deep dive today is to really unpack exactly how they achieved that 55% ROE.
We want to tear down the underlying segment performance, look at where these margins are coming from, and, frankly, highlight some notable risks that are kind of hidden in the flows.
Because there are always risks, even in a quarter this strong.
Always. So let's pivot right into the primary driver of this quarter's success, which is the Advice and Wealth Management segment, or AWM.
The real engine of the firm.
Exactly. AWM generated $3.4 billion in revenue, which is up 16%.
And pre-tax adjusted operating earnings were $939 million.
With the margin staying rock solid at 28.9%.
Which is incredibly healthy.
But the detail that really jumps out to me is the asset mix. Total client assets were $1.24 trillion, but it was heavily driven by wrap assets.
Ah, yeah, the wrap accounts.
Those surged 19% to $732 billion. I mean, to me, this wrap account structure feels like Ameriprise is running a highly lucrative financial subscription model.
That's actually a perfect analogy.
Right, because it creates this sticky, incredibly predictable revenue.
Yeah, once a client is in that wrap structure, they're paying a flat percentage of their total assets under management.
Instead of paying, choppy commissions every time they make a trade.
Exactly. The revenue just becomes this reliable baseline.
Yeah.
But I want to look at the execution here, because managing that growth is tricky.
Well, yeah, and this is where I've got a bit of pushback on how they are balancing everything.
Okay, what do you mean?
So they recruited 79 experienced advisors this quarter.
Which is a solid recruiting class.
It is. But onboarding experienced talent is notoriously expensive and disruptive. You have transition bonuses, downtime while they move clients over, new software to learn.
And the friction is huge, yeah.
Right. So usually when you inject that much headcount at once, you'd expect average productivity to take a temporary hit.
Sure, just from the dilution of the new folks ramping up.
Exactly. Yet their advisor productivity just hit a brand new high of $1.2 million per advisor. Up 12%.
It's an incredible metric.
So my question is, how on earth is Ameriprise balancing the onboarding friction of these new hires while simultaneously squeezing hyper-productivity out of everyone else?
Well, it comes down to how they monetize a book of business. That 1.2 million average isn't just coming from the wrap account fees.
Okay, so what else is driving it?
Management pointed directly to a 13% increase in transactional activity.
Wait, really? Even with the massive shift toward fee-based wrap accounts?
Yeah, exactly. The transaction business is still a huge lever for them.
So what are they actually transacting to get that kind of bump?
Mostly annuity products and brokerage transactions.
Ah, okay.
Yeah, they've built this ecosystem where the advisor gets that steady recurring fee from the wrap account, but they can also actively place clients into complex structured products.
Like variable annuities.
Right, exactly. And those carry much higher upfront transactional margins.
Which makes sense for an aging retail demographic that needs, customized retirement stuff.
Exactly. It's a dual engine approach, and that's what's pushing revenue per head to $1.2 million and basically masking any friction from the new recruits.
That makes a lot of sense. But we do need to talk about the risks, because AWM was not flawless this quarter.
No, the client flows definitely had a speed bump.
Right. Client flows were positive at $3.1 billion, but management was very clear that this was heavily hampered by advisor departures, specifically the Comerica terminations.
Yeah, that's a classic vulnerability in this space.
When a third-party bank like Comerica decides to walk away, those assets just vanish.
It's the inherent risk of being a white label platform. You don't own the end client. The bank does.
So if they pull the plugs, the capital bleeds out.
Exactly. But to contextualize that risk, you have to look right back at the guidance we talked about at the top of the show.
The Huntington Bank partnership.
Bingo! The impending $28 billion Huntington deal is basically the release valve for that pressure.
So it's going to more than offset whatever left with Comerica.
Oh, several times over. It proves that while partner churn is always a threat, Ameriprise has the enterprise scale to just go out and win larger partnerships to plug the gap.
Okay, so that's the asset gathering side in wealth management.
Hmm.
Let's shift gears to the manufacturing side, the asset management segment,
Where things get very interesting with the margins.
because there's a glaring contradiction in this report.
Mm-hmm.
Let's lay out the numbers. Asset management revenues were $947 million, up 14%,
And earnings jumped 23% to $274 million.
with a margin that just exploded upward. It grew by 370 basis points to hit a massive 42.7%.
Which is driven by stellar investment performance. I mean, 69% of their retail funds beat their median peers on a one-year basis.
And 87% beat them on a 10-year basis.
It's an incredible track record.
It is. But here was where I have to push back hard. Total net outflows for this segment were $6.5 billion.
Yeah, that's a big number.
Right. So wait, if you have a business bleeding $6.5 billion in asset outflows, how on earth are you simultaneously expanding your profit margin to nearly 43%?
It's the ultimate paradox of asset management, right? But if you unpack that $6.5 billion outflow, it starts to make sense.
Okay, unpack it for me.
It's heavily concentrated on the institutional side. We are talking $5.1 billion of that outflow was institutional money.
Leaving just $1.4 billion in outflows for the retail and model delivery side.
Exactly. And the retail outflows actually improved due to higher gross sales in the U.S. and the EMEA region.
But why is the institutional money fleeing at such a crazy rate?
Because institutional capital pensions, endowments, they just operate differently. They are highly sensitive to macroeconomic models.
So they just rebalance without caring about the fund's 10-year track record.
Bingo. If their model says rotate to private credit, they pull the capital immediately. But the margin expansion, despite those outflows, really comes down to the total assets under management.
Which is sitting at what, $759 billion?
Right. So even if you lose $6.5 billion to outflows, if the broader equity markets have a great quarter and drive up the value of that massive $759 billion base.
The sheer market appreciation just covers up the outflows.
Exactly. And management noted their underlying fee rate remained stable. So you apply a stable fee to a huge market-appreciated pile of money, and your revenue goes up without you having to spend a dime to acquire it.
Which mathematically forces the margin to expand.
You got it. It's pure operational leverage.
Okay, but if the market is doing all the heavy lifting, why did their general and administrative expenses, their G&A, rise by 9%?
Ah, yeah.
That feels a little concerning, right? Are they losing control of their costs?
It looks like a red flag initially, but it was actually a byproduct of success.
Also,
Management said that G&A bump was largely higher compensation for their Seligman strategies.
the tech-focused funds.
Exactly. Tech had a massive run, and those strategies saw huge AUM growth. So you have to pay the portfolio managers for outperformance.
So it's basically a success tax. You're paying the talent that delivered the alpha.
Right, along with a little bit of unfavorable foreign exchange impact, but mostly it's performance pay.
All right, so we've got AWM generating sticky fees and asset management printing 43% margins. That brings us to cash flow and capital return.
This is where you see what management is actually doing with all that money.
And to see that, we have to look at the legacy business, retirement, and protection solutions, or RMPS.
The insurance block.
Exactly. Earnings here actually dipped a bit, down 6% to $202 million.
But sales surged 20% to $1.6 billion.
Driven by huge demand for structured variable annuities and variable universal life.
Right, because you have this aging demographic that wants defensive growth. They want a floor to cap their losses, but they still want to capture some upside.
So my thesis here, and I want to see if you agree, is that this legacy insurance block has basically just become a quiet cash cow.
I would absolutely validate that thesis.
Right. Because they aren't chasing risky growth. They're just taking that predictable free cash flow and funding massive share repurchases.
Oh, the buybacks are aggressive.
They returned $932 million to shareholders in Q2. That is 91% of their operating earnings.
They bought back 1.7 million shares at an average of $459.
Which mathematically inflates that EPS beat we talked about at the start. But they are also funneling that cash into tech.
Yes.
Fortune just named them one of America's most innovative companies of 2026.
And CEO Jim Cracchiolo made a point to highlight their accelerating AI adoption.
Yeah, they're bringing advanced AI right into the advisor's workflows.
Which is brilliant because instead of taking on risky new insurance policies, they deploy the cash into stock buybacks, increasing capital return by 25% in the first half of the year, and into AI tools that feed directly back into that $1.2 million advisor productivity metric.
So the AI strips out the administrative bottlenecks, the advisor gets faster, they generate more revenue, which creates more cash flow for more buybacks.
It's a perfectly calibrated machine.
So to quickly recap for you listening, Ameriprise is flexing a 55% ROE.
They've got near 43% margins in asset management.
Record-breaking advisor productivity. And they're aggressively buying back their own stock.
It's just a masterclass in execution. But, as you process all this, there's one provocative thought I want to leave everyone with.
Oh, let's hear it.
With advisor productivity already at 1.2 million and AI now being rapidly integrated to automate all those workflows, is there a natural ceiling to how many assets a single human can actually manage?
That's a great question.
Right. Or is Ameriprise basically building the blueprint for the industry's first true super advisor?
Wow, yeah. A fascinating structural question to mull over for the next few quarters. That's all for this deep dive. Make sure to follow the show for daily, no-nonsense earnings coverage.